You've probably seen the charts. Candlesticks flashing green and red, indicators crossing, patterns forming and breaking. And somewhere deep down, you believed there's a secret formula, a way to predict exactly where the market will go. That if you just study enough, memorize enough, or follow enough expert advice, you'll finally crack the code. But what if I told you that everything you were taught about technical analysis is incomplete? That the very tools you trust the most can be, and often are, used against you? That there's a dark side, a side they never teach in trading schools, webinars, or courses, and most retail traders never see it until it's too late. Let me take you into the story of Alex, a retail trader from California. Alex was bright, dedicated, and extremely disciplined. Every morning, he woke up at 5 a.m. to study charts. Every evening, he analyzed patterns, candle formations, and indicators. One day, he spotted a perfect setup, a bullish engulfing pattern on a major tech stock, confirmed by a strong RSI divergence. It was textbook. He felt confident. He went all in. Within hours, the stock tanked. He had no warning. His stop losses were triggered. He lost more in one day than he had in an entire month of profits. Confused, he reviewed the charts again and again. Everything said it should go up, he kept telling himself. And that's when he realized the charts didn't fail. He failed to see the bigger picture. He was trading in someone else's game. You see, technical analysis works under one condition, when you are trading against someone equally uninformed. But the market isn't a fair game. Behind the scenes are hedge funds, institutional traders, and algorithms that move billions in milliseconds. They know where retail traders have placed their stops, where they'll enter, and where they'll panic. And guess what? They use it. Take support and resistance levels, for example. Every trader has memorized them. Price hits support, it bounces. Price hits resistance, it falls. Sounds simple, but the reality? These levels are hunting grounds. When retail traders cluster their stops around support, smart money will push the price just enough to trigger those stops, then reverse it in their favor. That textbook support didn't fail. It was exploited. You were just bait. Candlestick patterns are another trap. Doji, hammer, engulfing, head and shoulders. They all carry psychological weight. Retail traders see these patterns as signals of certainty, but algorithms scan them faster than humans can blink. So while you think a bullish engulfing candle is your confirmation, the market has already anticipated your reaction and used it to create liquidity. And let's talk about indicators. RSI, MACD, moving averages, all lagging indicators. They're based on past price action, which means by the time you act, you're already behind. Worse, many traders treat them like guarantees. You see a MACD crossover and buy, thinking the trend is confirmed. Meanwhile, the market reverses immediately after, leaving you on the wrong side. Consider Emma, a trader from Chicago. She relied heavily on RSI divergences. She spotted a divergence in a major currency pair and entered a long position. For 3 days, nothing happened. Then suddenly the price plummeted, wiping out nearly half her capital. She checked the charts. Everything was pointing to a bullish trend. And yet, she was crushed. That's when she realized, charts don't lie, but markets do. Someone else was controlling the narrative. Someone else was pulling the strings. Here's the uncomfortable truth. Technical analysis creates illusionary predictability. It makes you believe there's a method to the madness. And when things go wrong, you blame yourself. You question your skill, your strategy, your discipline. And meanwhile, the smart money profits quietly. Even the education around technical analysis is designed to keep you chasing illusions. Courses, books, webinars, they cherry-pick successful trades, oversimplify complex strategies, and rarely show losses. You only see the wins, and you start thinking success is just a matter of following the right patterns. But the truth? Those patterns are only effective in certain contexts, and most retail traders never understand the context. Let's go deeper into the psychology behind this. Humans are wired to find patterns, to seek certainty in chaos. Technical analysis preys on that. Every candlestick, every breakout, every indicator is a psychological lure. Your brain sees confirmation where none exists. You want to believe you're making informed decisions, but really, you're following cues designed to trigger emotional reactions. Fear, greed, hope. And here's another layer you've probably never considered. Confirmation bias. When you study charts, your brain filters information to match what you want to see. That breakout? it must succeed. That bullish candle, it must signal upward momentum. And all the while, your emotions cloud judgment. Technical analysis doesn't prevent emotional mistakes. It often disguises them. Then there's the issue of market manipulation. Every large move, every sudden spike, every crash, often these are orchestrated. Smart money doesn't just trade. They plan. They hunt for liquidity, exploit predictable retail behavior, and move massive sums to trigger reactions. And the retail trader? They're like a moth circling a flame. Candlestick patterns, support and resistance, indicators, these aren't failing you. They were never meant to guide you safely. They were meant to manipulate behavior. Think about this. Why do most retail traders fail, even after years of studying charts? Because the market is not a level playing field. When you buy, someone is selling. When you short, someone is buying. And those on the other side have far more information, better tools, and faster execution. You're not trading against another equal trader. You're trading against systems designed to profit from your predictability. Now, don't get me wrong. Technical analysis can be useful. It helps gauge sentiment, identify potential turning points, and understand market psychology. But if you treat it as a crystal ball, as a guaranteed formula, you're walking into a trap. And most traders do. They chase setups, follow signals blindly, and hand over their money. So what's the solution? Awareness. Understanding the psychology of the market. Recognizing that charts are maps, not guarantees. Seeing patterns as reflections of collective human behavior rather than sacred laws. Combine this awareness with proper risk management, discipline, and observation. And you start to trade like someone who anticipates moves rather than reacts to them. Cutting losses early isn't weakness. It's survival. Following textbook rules without context is a guaranteed way to hand your money to those who understand context better than you ever will. The market is not your friend. It's a battlefield, and predictability equals vulnerability. Technical analysis, in the wrong hands, can make you the prey. If you've made it this far, congratulations. You're already seeing behind the curtain. You're questioning what you've been taught. And that's the first step. Step 2 is learning to combine awareness, strategy, and risk management in a way that protects your capital from the hidden forces in the market. Before you buy another course, follow another signal, or trust another expert, ask yourself this: are you learning to trade? Or are you learning to follow a system designed to profit from your predictability? Because the answer will define your future in trading. And if this opened your eyes, don't stop here. I've got more content exposing market manipulation, hidden liquidity traps, and how the smart money moves while retail traders are blindsided. Make sure you subscribe, hit the bell, and check out the other videos. Because the more you understand these hidden truths, the less likely you'll end up on the wrong side of the market next time.